Hi, I'm Sheree Bergeron and this is Chapter 14. This chapter is going to be talking about long-term liabilities. So let's just remember what we're talking about when we say the word long-term. That means that we are not going to pay these for more than 1 year. And the opposite of that is a current liability, which we would pay in less than a year. And the word liabilities means that we owe it. So this chapter is going to be about term liabilities. So let's first look and see some ways that we can think about, should we borrow money or should we do what we did in the last chapter, which is issue stock? So one way that companies tackle this decision is to see what would the impact be on its earnings per share. So we have several different options. We can have short-term debt, long-term debt, or as in the last chapter, chapter 13, we can issue stock. And we've got to make decisions about what's best for our company. So we're going to do a scenario that helps us to do that. All right, but first, let's look at what a long-term liability is. So one example of a long-term liability is a bond. So this is an interest-bearing note, which means that we borrow money and pay interest on it. And like a note, it requires periodic interest payments with the face amount to be repaid at the maturity date. So this is what's different about the notes that we've talked about in the past. In an installment note, which we'll do later on in this chapter, you repay the principal throughout the life of the loan. But in a bond, you wait and you don't pay it back until the very end. So you make interest payments throughout the life of the bond, but you don't pay back the principal amount until the very end, and that's called the maturity date. Okay, so when we are making business decisions about how we want to finance our company, do we want to issue stock, do we want to issue bonds, we're going to be looking at a measure called earnings per share. And it is exactly as it sounds. It is the earnings or the net income per share of stock. So a reason that we look at this is because this is important to stockholders. And so the way that we finance our company, we want it to remain strong. And so one measure that we would look at is called earnings per share. Okay, so we calculate it with net income. That's what you would find on your income statement, minus preferred dividends. All right, the reason that we take out preferred dividends is because those are promised to the preferred shareholders. And this measure is for the common stockholders. So we want to only show the net income that is available to the common stockholders. And then we divide it by the number of shares outstanding, just the common shares, because this is just for common stockholders. And that will give you your earnings per share of stock. Okay, so let's look at an example. If we have Bose Corporation, a $4 million company, is considering the following plans to issue debt and equity. So they want to borrow or issue stock and receive $4 million. And they've got to think about, do they want to issue stock or bonds or a combination of both? And what will the impact be on earnings per share? Which of these choices will give them the strongest earnings per share? So they'll give us a lot of information. For example, they'll tell us your net income, how much your income taxes are, what your tax rate is, and then we will do the calculation to see which is best. All right, so in Plan 1, they were just going to issue common stock. So that's what you'll see right here. And in Plan 2, they're going to issue some preferred stock and some common stock. And in Plan 3, they're going to issue some bonds, some preferred stock, and some common stock. So what we'll do is notice that the total is always $4 million because that's how much money this company wants to receive. And then we're going to look at the impact on earnings per share. So the earnings before interest and income tax, this is your net income before you take out any interest for these bonds and before you calculate your income tax. And that will always be given to you, and it's $800,000, and this number will be the same. And then we're going to impact that by our different plans. All right, in Plan 1, we don't have any bonds, so there's no interest on bonds. In Plan 2, we also don't have any bonds. But in Plan 3, we do have some bonds. So what you'll do is you'll take the bond amount, which is $2 million, times the bond interest rate, which they'll tell it to you, and it was 12%. And that's where we get the $240,000. So this is significant because it reduces your taxable income, which makes you pay less income tax. That's why we take it out right there. All right, so then you get to income before income tax. That means your net income minus your interest, and that's what you're going to use to calculate your income taxes. They'll tell you what your tax rate is. Your income tax rate is 40%. They'll tell you to use that number. So you'll say income times 40%, and you'll get your income tax for Plan 1, Plan 2, and Plan 3. Notice which plan has the least amount of income tax. It's Plan 3. And that again is because you got to deduct your bond interest. All right, then you can get to net income, which is just your income before income tax minus your income tax. And then we'll take out our dividends on preferred stock. All right, so as a review from the last chapter, how do we calculate dividends on preferred stock? We learned that it is the dividend percent, which is percent, and that's the dividend percent, times par, times number of shares. That's how we calculated it in the last chapter. Well, we also know that par times number of shares is the value given here. So par times number of shares for Plan 2 equals the 2 million. So all we have to do to figure out the dividend is multiply that by the dividend percent, which is given down here as 9%. So if I say 9% times 2 million, that's 180,000. 9 times 2 is 18, so 180,000 is my dividends for Plan 2. Let's look at Plan 3. The 1 million is the percent, or the par times number of shares. So we'll just say 1 million times that dividend percent, which is given at 9%. And so it is $90,000. So that's how you can calculate your dividends on preferred stock. So we'll take that out of our net income because that's what's left for common stockholders. And so for Plan 2, we're left with $300,000 as net income for common stockholders. And for Plan 3, we're left with $246,000. All right, so thinking back to that formula for earnings per share. Remember, it was net income minus preferred dividends divided by number of shares. So we are finished with this part. Net income minus preferred dividends is given right here. That's our numerators for everybody. Then our number of shares is the number of shares of common stock outstanding. All right, so for Plan 1, it's 400,000. So we can get that because we knew that Plan 1 was 4 million, right? And we can divide 4 million by the par and get the number of shares. Okay, for Plan 2, we can say 2 million divided by par, and that will get you the number of shares, 200,000. For Plan 3, 1 million divided by $10 par gets you to 100,000. I want to remind you from the previous chapter why that works. We know that you always put common stock at par value, which means that it's always number of shares times par value, and that gave you the amount of common stock, right? Well, here, let's look at Plan 1. The 4 million is this number right here. We don't know number of shares, that's what we want to know, but we do know par value. So we can solve for number of shares by dividing, because we know number of shares, we'll call that number, times $10 par equals 4 million. So if we want to solve for x, we got to get x by itself. We can divide this by 10, that crosses that out, divide this by 10, and so that gives you number of shares. So that's why it works. You don't have to go through that each time. You can just remember that you can say 4 million divided by par, 2 million divided by par, 1 million divided by par to get that each time. All right, and then your earnings per share becomes $1.20, $1.50, and $2.46. So we're going to work a problem in the chapter together a little bit slower than this. I just wanted to give you a brief overview of looking at these financing plans. So Plan 3 gives you the highest earnings per share, so we would choose Plan 3 in this situation. So Plan 3 had a little bit of bond, a little bit of common stock, and a little bit of preferred stock. This chapter is going to be focusing on bonds and later on the note payable. All right, so bonds. there are some terminology that we need to learn. First of all, the face amount of each bond is called the principal. This is the amount that we have to pay back at maturity. So it's usually 1,000 or a multiple of 1,000s. The principal must be repaid on the dates the bonds mature. The interest on the bonds may be paid annually, semi-annually, or quarterly. Most bonds pay semi-annually, and every bond that we do in this chapter will be paid semi-annually, which means twice a year. The contract between the company that issues the bonds, that's the side that we'll be on, and the bond holders, that's who we issue it to, that contract is called the bond indenture. So, two common types of bonds. One is term bonds. All of these bonds mature at the same time. So let's say they all mature in 20 years. You got to pay them all back on the same date. Serial bonds mature over several dates. So you may pay them back over a 3-year time span. All right, there are some more complicated bond structures, and you don't need to know much about them. You just need to know the definition. If it's a convertible bond, this means that the bonds may be exchanged for shares of common stock. So that means that the bond can be converted to common stock. A callable bond means that you can call it early. This means that you can pay it off early. So bonds that can be redeemed means to pay it off by the corporation prior to their maturity. So say the company has the money to pay it off, they don't want to pay any more interest. If it's a callable bond, which would be stated in the indenture, they can pay it off early. All right, so when we issue a bond, that means we borrow the money. We get proceeds. Proceeds just means we get the money. So we get proceeds from issuing the bond. So the amount that we get is going to depend on several things. First of all, the face amount of the bonds. All right, so let's say our bond says it's worth $1,000. It's also going to depend on the interest rate of the bonds. So we're going to have a contract interest rate, let's say of 8%. But out there in the market, we have other things being exchanged, and they have market interest rates, and they will usually be different. So because the market interest rate, this is out in the market, is different than the contract rate on the bond, that will affect how much we get for that bond. All right, so let's look at the rules to see how much we're going to get for these bonds. So if the contract rate of the interest, that's the amount that was written on the bond, is equal to the market rate, okay, so we got lots of different rates over here, and let's say they all average to 8%, then we will get the face value of the bond. So that means that we will get the $1,000 because the contract rate of the bond equals the market rate. And that's the most simple scenario that we have. Another word for the market rate, which is out here in the market, it can be called market rate or effective rate. Both of these mean the same thing. Okay, so again, if the market rate, this is the one we've already talked about, is the same as the contract rate, then the proceeds that we get, that's the selling price of the bond, is equal to the face amount. We would get the $1,000. But let's look at this one. If the market rate is greater than the contract rate, then that means that we're going to have to sell this at a discount, which means we're going to get less money than $1,000. Let me tell you why. Because our bond holders are going to get the interest that's written on our bond. So if it's 8%, they're only going to get 8% every 6 months. But if they went out to the market, they could get more. Therefore, they're not going to pay us the whole $1,000. We're going to have to discount that in order to sell it. And so the discount amount will be the amount that we would get. Let's look at the last scenario. If the market rate is less than contract rate, okay, so that means that we're going to pay them the 8%, for example, every 6 months. But out in the market, they could only get 7%. Well, we're not going to be willing to sell that $1,000 bond for $1,000. We're going to put a premium on it and sell it for more. It's important to realize that all the amount that we sell it for, that face value that we're going to get, the proceeds that we're going to get, just makes our bond equal to market interest rate. Okay, so it's not better or worse to have any of these situations, because we're going to true up the price to actually equal the market value. This will make sense the longer we go. So let's just keep going. Okay, so if we issue a bond, let's look at this. The price of a bond is quoted as a percentage of the bond's face value. So if I tell you that we have a $1,000 bond at 98, and that's how we say it, we say a $1,000 bond at 98 or quoted at 98. That 98 is a percentage, which means that you take this and you move it over 2 places. So you can either call it 0.98 or 98%. And you'll just say 1,000 times 0.98, and you will see that the proceeds received on a bond at 98 would be $980 if it's a $1,000 bond. All right. Likewise, if you have 109, you still take that decimal right there and move it over, but this one equals to 1.09, which is a premium, because you say the $1,000, if that's your face value, times a 1.09, and you find out that you would get 1,090 for that. So you got more than face value. So if your bond is quoted at a number less than 100, it's a discount. And if it's more than 100, it's a premium. So this is a discount and this is a premium. All right, so when bonds are issued at less or more than their face value, the discount or premium must be amortized over the life of the bonds. You can think about amortization similar to depreciation. That is the systematic allocation of the value over time. So what we're going to do is we're going to move it out of premium or discount and into interest expense over the life of the bond. And I will show you how to do that. But for right now, I just want you to know that amortize means that we will be allocating premium or discount to interest expense over the bond life. I want you to revisit that definition a few times after we show you some examples so that it can make sense. Okay, assume that on January 1, 2025, Eastern Montana Communications issued the following bonds. The face amount is $100,000. The contract rate is 12%, so this part right here is written on our bond. The market rate of interest is 12%. So this is good news because this is equal. That means that we will receive face value and not have to worry about any premium or discount. The term of the bond is 5 years, so we're going to have to pay it back in 5 years. Here's what we're going to do when we issue those bonds. We're issuing bonds because we want the proceeds. So we get cash, that's our proceeds, of $100,000, and then we credit a liability called bonds payable to show that we're going to pay it back in 5 years. All right, so what did cash do? Did it go up or down? It went up because that's what we're trying to do. We're trying to get cash. And then what did bonds payable do? Did it go up or down? It went up because we owe additional liability. Okay. So that was an example of when we issued bonds at face value because there was no premium or discount. Then every 6 months, we're going to pay interest. You calculate that by saying face value times the contract interest rate times 6/12 because we pay it 2 times a year. And so you can either say 6/12 or 1/2. I like to say 6/12 because occasionally you'll have to accrue something and you'll only do 3/12 or something. So it's a good habit to get into saying your months that you're doing. And then that equals the $6,000. Okay, so the journal entry for that is to debit interest expense. That increases your interest expense. and to pay the bondholders cash, so you decrease your cash for the $6,000. All right, after you do that 10 times, because you did it 2 times a year for 5 years, you repay your bond. So when you repay your bond, you get rid of your bonds payable, so you reduce your bonds payable by the full amount, and you reduce your cash to pay it off, and then you're finished. All right, let's do an example of a bond issued at a discount. So here we have the face amount is still $100,000 and the contract rate is 12%. So this is written on the face of the bond. The market interest rate though is 13%. So here you have to ask yourself, well, they're going to get 12% every 6 months, but in the market they could get 13%. Will they like this bond? No. So we have to discount it so that they don't pay as much, since they won't be getting as much interest on our bond as they would out in the marketplace. So this is a discount. All right, so when we issue this bond, it has to tell you either the quoted percent or simply how much cash we got. So let's see what this problem gives us. It says that we issued a 1,000,000 6% 5-year bond that pays semi-annual interest of $30,000, receiving cash of $936,420. All right, so it told us how much cash we got. That's our proceeds. That's the discounted amount. So debit cash for that amount. And then we always pay back face value. Make yourself a big note that the bonds payable will always equal your face value. So then the question is, what do we need to balance? We have a debit of $936,420, a credit of $1 million. What are we off by? We're off by $63,580. That is our discount. We can look and see that in order to balance this journal entry, we needed a debit. You can remember that discount has a normal debit balance. And it's nice that debit and discount start with a D, so you can remember discount has a normal debit balance. Now we're going to learn how to amortize that bond discount. Don't worry, it's not hard. It's just a lot of words to get to it. All right, so the entry to amortize a bond discount looks like this. Do you remember that discount has a normal debit balance? So a normal debit balance, a normal debit balance means that discount, when we put it in there, had a debit balance. When we go to amortize it, we're going to be reducing it. So that means that we credit it to amortize a discount. So that's why we credit discount on bonds payable. All right, we move it to interest expense. So if you remember, in our example, we had a bond that was, let's see what that one was. Contract rate 12%, market rate 13%. All right, so contract rate 12%, market rate 13%. So the reason that we discounted it is because we needed to get our bondholders up more interest to 13%. So that is why a discount increases interest expense, because it really represented additional interest that we needed to get our bondholders to, because we're only paying 12%, but they really deserve 13% in the market. All right, so that is why we move it out of discount and into interest expense. Okay, so we're going to make this entry though in combination with our semi-annual interest payment. So when we pay them every 6 months, not only are we going to pay them their interest, we're going to also amortize our discount at the same time. Okay, so the easy number is to figure out our cash. That's the face value times the contract interest rate times 6/12 every time, no matter what. Discount on bonds payable, remember we said we're going to credit it. That's going to be discount, and I'll show you in a minute, divided by number of periods. So if it's a 5-year bond, it'll be by 10 periods. Interest expense, will just be the cash plus the discount. All right, let's put it into some numbers so that we can see this. Assume that the amortization of the Western Wyoming distribution bond of $3,594 is computed as followed. So the total discount and the term of the bonds is 5 years. So we're going to say the discount divided by 10 periods because it's a 5-year bond. So we pay interest twice a year. So 5 times 2 is 10. And so our semi-annual interest or semi-annual amortization is $359.40. All right, so here's what it looks like. Cash, which is going to be, remember, face value times contract interest rate times 1/2 or 6/12. That equals $6 million. Discount on bonds payable, we credit it because we're reducing it. And then interest expense is equal to these two numbers added together. Okay, so now let's look and see what the impact of this discount amortization is. Notice it increased interest expense every single semi-annual interest payment date, every 6 months. In effect, this increases the contract rate of interest to a rate of interest that approximates the 12% or the market rate. Remember, we were trying to get from 12 up to 13%. That's why it increased our interest expense. In addition, as the discount is amortized, the carrying amount of the bond increases until it equals the face amount of the maturity date. So the carrying amount of a bond is equal to this. So we have our bonds payable minus the discount that's in the balance of the discount account gets you to your carrying value. So at first your carrying value is lower than what it needs to be at maturity date. But throughout the life of the bond, you are slowly getting rid of this discount amount. Every time you amortize it, you're getting it down further till eventually it equals 0 and your carrying value is equal to what you need to pay back for your bond. Because you always pay back face value of the bond, so then bonds payable minus nothing equals bonds payable. That's what you need to pay back. All right, so go ahead and work this example exercise. Pause it, then check your work here, and we'll keep going. We're going to issue bonds at a premium. And so when we issue bonds at a premium, it works the same, except instead of having a discount, we have a premium. And a premium increases your bonds payable. Remember, a discount reduced it, so a premium increases it. So a premium has a normal credit balance. So I like to call it a creamium, so that creamium and credit can have the same C to remind you that a creamium has a credit balance. Okay. So, and I don't think you'll hear that any other place, but sometimes I crack myself up in class when I talk about that. So feel free to do that if that makes you laugh. Okay, so the contract rate of interest is more than the market rate of interest, and that's why we're going to sell it for more than their face amount. So every 6 months, our bondholders will be getting more than what they could get into the market. So they have to pay us more up front. Over time, this will reduce our interest expense. Let me show you how that works. So in this case, we have a bond of $2 million, 12%, 5-year bond that pays semi-annual interest of $120, receiving cash of $2,154,000. So you can see that the cash that we got is higher than the amount that we had to pay back. That additional amount that they gave to us that we will never pay back is us taking back their interest expense because we only pay them market. Okay, so this is our initial issuing of the bond. When we issue the bond, we got $2,154,440 of cash. We promised to pay them back. This is always face value, $2 million. The difference that we need is a credit. So that's why it's a premium of $154,440. So a premium has a normal credit balance. Now, every 6 months, we're going to start to reduce this. And this is the way it's going to look when we do that. So a premium has a normal credit balance, right? So every time we amortize it, we've got to debit it to amortize it, to start to reduce it. The opposite of a debit is a credit, which means we're going to credit interest expense. Okay, so if we have to debit the premium to make it go down, we're going to credit interest expense. What does a credit do to interest expense? Does it make it go up or down? So expense has a normal debit balance. So if you credit interest expense, you are reducing it. Okay, so remember, this is just the entry to amortize a bond. Going to combine it with our interest payment and actually make this entry right here. So the way that we do that is the cash is always the amount that we pay to our bondholders for interest, which is always calculated as face value times contract interest rate times 6/12. Then the premium on bonds payable we just calculated above will be a debit, and we'll calculate that by saying the total amount of the premium divided by the number of periods. And then interest expense, in the case of a premium, will be cash less amortization of the premium. Remember, when we had a discount, it was cash plus amortization of a discount. But for premium, we subtract. All right, let's look at this example. If our total premium is $3,769, to calculate how much we want to amortize every 6 months, we divide that by the number of periods. So if our term is 5 years, we say 5 times, we pay 2 times a year. Our number of periods is 10. So 3769 divided by 10 gives you amortization. This is how much you're going to amortize every 6 months. Okay, so take a minute and work this example problem, and then pause it and then check your work. Here's your example problem right here. And then check your work. Bond redemption. This is when we pay off our bonds. So a corporation may redeem or call bonds before they mature. This is often done when the market rate of interest declines below the contract rate of interest. So in such cases, the corporation may issue a new bond at a lower interest rate and use the proceeds to redeem the original bond. So if we have a bond redemption before they mature, then we are going to have a gain or a loss that we need to calculate on this. All right, so the gain is recorded if the price paid for the redemption is below the bond carrying amount. And remember, the bond carrying amount is the face value minus any remaining balance in the discount, or the face value plus any premium balance. So we're just going to compare the carrying value to the amount that we have to pay to redeem it and see if we have a gain or a loss. So assume that on June 30th, 2025, a corporation has the following bond issue. Face amount is $100,000, premium on the bond payable. So the current premium balance is $4,000. So right now our carrying value, remember a premium adds to get to our carrying value, is $104,000. So it has to tell us how much we had to pay off these bonds. So it says that we redeemed 1/4 of these bonds in the market for $24,000. So that means that we got had to pay back $24,000. So we're going to give our bondholders $24,000 to pay this off. So that's why we credit cash for that amount. Only the portion of the premium related to our redeemed bonds is going to be written off. So we're going to get rid of the premium related to this. So our total premium was $4,000, but we're only redeeming 1/4 of these bonds, so 25%. So we're going to say 4,000 times 25%, and that's how much premium we're going to write off. So let's talk about writing off a premium. Remember, it's a premium, so that $4,000 is sitting on the credit side, right? So we want to write off 1,000 of it, which means we're going to debit it. So we're going to reduce our premium by $1,000. All right, and then we always pay back face value of our bonds. The bond's face value in total was $100,000, but we are only getting rid of 25%. So 100,000 times 25% is equal to 25,000. So we're going to get rid of the bonds payable of 25,000 because we're paying those off. So to get rid of a liability, we debit it. The difference that we need to balance now is a gain because we need a credit to balance. So the way I like to look at this is the face value that we're giving up is 25,000. The premium related to that 25,000 is 1,000, which means that the carrying value is 26,000. We had to pay off 24,000. So that means that the carrying value was higher than the amount that we had to pay. So this means it's a $2,000 gain. So you can write down that formula to calculate your gain or loss on early redemption of a bond. This example is going to show what happens if we then redeem the remaining bond. So if we call the remaining $75,000 of outstanding bonds for $79,500, the $479,500 means the cash that we're going to have to pay. So the cash that we have to pay is $79,500 right here. And then the value in our liability is $75,000, so we need to get rid of that by debiting it. The remaining premium that we need to get rid of was $3,000, and in this case we had a loss. So again, we could see that by saying that the bond carrying or the bonds payable is $75,000 plus the remaining premium $3,000. So our carrying value is $78,000. We compare that to the proceeds that we had to pay. This time we had to pay more, so that's why it was a loss of $1,500. Okay, and again, that formula is bonds payable plus or minus the premium gets you to the carrying value. Compare that to proceeds to get you to the gain or loss. All right, so pause it, work this example, see if you have any questions. That brings us to installment notes next. So we're going to leave bonds behind and talk about installment notes. Installment notes are similar to what you would have if you took out a car loan or a mortgage on a home. So it's different because instead of waiting until the very end to pay off the total amount, you're going to pay off a little bit of the principal as you go. So when we say we issue an installment note, that means that we get cash and set up a liability. So in this example, we have a principal amount of note of $24,000, an interest rate of 6%. It's a 5-year note, and we're going to have annual payments of $5,698. So we're going to make a payment once a year, and that payment will never change. It'll always be $5,698. But as you see, what will change is the allocation between the amount that went to principal and the amount that went to interest. All right, let's start at the very beginning. Issue the note. So again, when we issue a note, that means that we get cash and we promise to pay it later. So we're going to increase our cash, we got $24,000, and increase our liability called notes payable. This is called an amortization of installment notes, and it's going to help us make our journal entries. So when we first took this out, we had $24,000 that we had to pay back. Our cash payment will never change. Notice these are always the same. But what does change is the makeup of that $5,698. In the first year, our interest expense is going to be $24,000 times 6%. So it's $1,440. So of our cash payment, which is $5,698, $1,440 of it went to interest expense. The remaining went towards paying off our principal. So that's why it's B minus C. $5,698 minus your interest gives you the amount that you decrease your notes payable for, because this is your principal interest. Principal payment, principal payment. This is how much it reduces your note payable. Your interest expense is going to be the carrying value. That means the amount that you still owe times your interest rate. All right, so let's look at how we calculate carrying value. It's going to be your original amount in A minus the amount that you just paid towards principal, D. That's how much you still owe right now. All right, so let's look at year 2. We start with our $19,742. We always pay $5,698, but this time our interest expense went down because we only multiply 6% times our new carrying amount. That leaves more to go towards principal, and then we get to a new carrying value. We go to the third year. Start with our new carrying value, make the same payment as always. Look how low our interest is now. It's because we don't owe as much on our note, so when we multiply it by 6%, it's even less. This leaves even more money to go towards our principal, and then that leaves us our new amount. This is why financial advisors tell you if you pay extra payments towards your house, you'll pay it off even faster because you're paying less interest over time and you're able to make more of a payment towards principal. So this is called an installment note. All right, so then you just make your journal entry straight from that table that you just saw. So your interest expense would come from that interest expense. Your notes payable is how much you're reducing your note payable by, and then your cash never changes. That's your cash payment. And you can take a look at each of these and compare it back to that table to see how this works. And at the very end, you will owe 0. All right, so take a minute, work this example exercise, pause it, and then check your work. Now we're ready to talk about how we report these long-term liabilities. So liabilities are on the balance sheet, and on a classified balance sheet, that just means that you break them down into current and long-term. So our long-term liabilities will include our bonds payable and our notes payable. So that's why you're going to see it down there. Now, the unamortized discount will just go right below the bond because it's just a contra account. And remember, contra accounts go right next to their account. So bonds payable less unamortized discount gets you to your carrying value. If it was a premium, it would have been plus to get you to your carrying value. So that's how we're going to report it on our balance sheet. All right, we always end with a financial ratio. So the ratios that we're going to be doing this time is called times interest earned. This is a good ratio to look at to see how many times you can pay your interest on these liabilities out of your current earnings. So the more times you could pay it, the better you are. So income before income tax, add back your interest expense, divide it by your interest expense, and that's going to tell you how many times you can afford your interest. So the higher it is, the better. Like all ratios, this is only helpful if you can compare it to last period, last year or several years ago, to see how you're doing compared to the past or to other businesses in your same industry. So let's say that your times interest earned is 6%, but somebody else in your industry is 10%. That means that they can actually afford their interest more than what you can afford. All right, we're going to conclude there, and let me know if you have any questions. Thanks.